According to the data, America is seeing one of its strongest economies of nearly all time. But if you ask the average American person, it's a very different story. Over the last 5 years, between 2019 and 2024, we saw this rapid divide between the working class and the investor class, because over the same 5 years, three things happened. First, it costs at least 20% more to buy pretty much anything today than it did back in 2019, according to the inflation data. But practically speaking, most things cost 30, 40, 50, sometimes 80, sometimes 100% more today than it did back in 2019. Like, according to the inflation data, $100 of groceries back in 2020 should cost you about $122 to $123 today. But I think the average person, myself included, is paying a whole lot more than that reported grocery inflation. So I'm going to be extremely generous. I'm going to say that the cost of things over the last 5 years have grown by 25%. Second, incomes have risen over the last 5 years. How much? Well, we're not actually going to know until at least next year. So instead of looking at income data between 2019 and 2024, I'm going to look at the Social Security cost of living adjustments, because every single year, the Social Security Administration increases how much money a Social Security beneficiary receives, because the cost of living has gone up year after year after year after year after year. And if we take a look at the Social Security increases between 2019 and 2024, we will see that the cost of income, the Social Security, has gone up by around 22% over the last 5 years. So we'll just say that incomes have risen by 22% over the last 5 years, even though a lot of people haven't seen a 22% increase in incomes over the last 5 years. But again, I am going to be generous here. And third, investors got a whole lot richer as stock prices boomed and as rental property values boomed. So how much richer did investors get? Well, it depends on what the investors actually invested in. But if you take a look at the S&P 500, which grew just over 70% over the last 5 years, we'll say that investors gained about 70% in wealth over the last 5 years. Now you can start to really see the problem. The cost of living, the cost of surviving in America over the last 5 years grew by 25%, and I'm rounding down here. But it grew by 25%, while the average worker might have gained in income about 22%, while the investors gained in wealth by around 70%, which means that for the average person, the average worker, your income didn't grow fast enough to keep up with the higher cost of living over the last 5 years. Which means for the average worker, you're having to use more of your income, more of your salary to pay for your groceries, to pay for your rent, to pay for your car, which means you have less money to go out and travel and buy other cool things, let alone save and invest. While investors, on the other hand, saw this disproportionate increase in wealth because stock prices, real estate prices, asset prices have been booming over the last 5 years. So now that I laid the foundation of what's going on, let me clear off the whiteboard and go a little bit deeper into what you need to understand. There are 3 very important points that I need you to understand by the time we get to the end of this video. And what I'm going to be going over are, number 1, the asset risk. You'll understand what that means in just a minute. Number 2, the why. Why are we seeing this disproportional divide between the working class and the investor class? And then number 3, which is the correction that you want to also understand. So let's start with number 1, the asset risk. But before we do, I have a little favor to ask of you, because now we are launching the Minority Mindset Show on audio podcast formats as well, or at least some of our episodes. And well, I need some reviews. So if you've gotten value out of the YouTube videos that I've been posting here and on the audio version of my Minority Mindset Show podcast, on the Minority Mindset Show podcast, on Apple and Google and wherever else podcasts are, I would love it. It would really mean the world to me if you could take 60 seconds, go onto podcast, find the Minority Mindset Show, and leave me a 5-star review and a comment to help our podcast start getting traction over there, because right now we just started posting some content there. We haven't really announced it anywhere, and I would love it if you could help us get a jump start with some amazing reviews. I really appreciate it. And with that, let me go into now the asset risk. I'm going to keep this part of the video relatively short because I just want you to understand that asset prices don't always go up in value. Asset prices go up and they go down. And I know there's a lot of young people out there who are now starting to invest money for the first time, or they've only been investing for the last few years, the last 5 years, the last 7 years. So they haven't seen a downturn in the economy per se. I mean, I know 2020 was a recession, but most people don't actually feel the real impacts of that recession. And the reason why this is important to understand is because asset prices go up and they go down. Housing prices go up and they also go down. Stock prices go up and they also go down. Now, over the long term, we've seen stock prices rise. Over the long term, we've seen housing prices rise. However, nothing can move linearly in one direction. And the reason why you want to understand this is because there's a lot of people that kind of have this idea that if I invest my money into the markets today, in 6 months it's going to be worth more money, in 12 months it's going to be worth more money, in 18 months it's going to be worth more money, in 24 months it's going to be worth more money, and on and on and on, instead of understanding that there will be times, not there might be, there will be times where markets go down. There will be times where our economy starts to slow down. And when those times happen, they create amazing opportunities. Because what ends up happening to the average person who's not financially educated is when you see markets start to go down, people panic. They freak out. And when people start panicking, they start selling. Now, one of the reasons why people will panic is because they have no idea what's going on. They think that the world is going to end no matter what's happening. They think the economy is going to collapse. They see their investment portfolio in the red. They see their investments starting to go down, and they want to cut their losses as fast as possible. So they freak out and they sell. The other reason why is because people also are investing with debt. This could be real estate. This could be stocks. It could be any asset class. And when you're investing with the debt, now, anytime you see a loss, it's a lot more expensive. Because it's not just your own money that you're losing somebody else's money. And then when you're trading on debt, well, now either you might be more tempted to sell, or your broker or whoever lent you the money might be forcing you to sell. And this forced sale then can create a bigger supply of assets because it forces more people to sell, which creates more downward pressure on the asset. It can push stock prices lower. They can push real estate prices lower. So what you need to understand here is that assets, stocks, real estate, any asset you can think of goes up and down in value. And yes, you can see a lot of upside when things are going up, but when things are going down, those also create some of the biggest opportunities. And so if you are investing your money, also, I want you to understand that if and when, actually just when asset prices go down, you have to stay calm and you have to find the opportunities. You may need to sell an asset if you're worried about it going bankrupt. If you invest your money into a stock and this stock could go bankrupt, then yeah, that would be a good reason to sell. But if you're invested into the broad economy and now you're worried about the economy collapsing, well, now you really need to take a breath and understand that, well, if the economy were to collapse, the least of your worries is going to be the stock market. Okay, so when you see the markets go down, understand that that also creates the most opportunities for the people that are financially educated. I mean, market crashes have created more millionaires than anything else because it gives opportunity to the financially educated with the people who have money to now go out and invest. The 2020 pandemic caused a stock market crash. The 2008 stock market crash and real estate crash created an asset price crash, but they also created huge opportunities for investors to go out and invest. I was buying a lot of stocks in 2020. I was buying real estate after the 2008 crash. These created opportunities for people to go out and buy investments at a huge discount, but you have to be financially educated and prepared. But I want you to also understand that now when you see asset prices go down, it will cause pain to some people, but it'll also create opportunity for others, and I want you to be on the side of opportunity, not on the side of pain.
We're going to jump back into the show in just a minute, but before we do, here are a few words from our sponsor, M1. If you've been watching my videos, you've probably heard of me talk about passively investing your money in the stock market, where you have a CPA, a consistent, passive, and automatic system where money is automatically invested into the stock market for you. Well, a super easy to use platform that can help you passively invest your money into the stock market is M1, and as a little disclaimer, at the time of me recording this video, M1 is a tool that I use to passively invest my money into my portfolio of ETFs. The way it works is you get to create your pie or your portfolio of ETFs or stocks that you want to invest in, and then you can create a cadence of how often you want to invest into this portfolio of ETFs or stocks. For me, I invest every Wednesday. You can invest every 2 weeks, every month, but once you pick the cadence, you set it and forget it, and M1 is completely free for you to use. Now, of course, investing has risks. Are you guaranteed to make money when you invest? No, of course not. In fact, you will probably lose money at some point, which is why you want to always do your own due diligence and never blindly trust a random guy on YouTube. But you can mitigate some of your risk by investing your money into good assets for the long term, which is why I invest my money into my portfolio of ETFs, whether the market's up and down because I'm investing for the long term. Now, of course, you want to do your own research, get a financial advisor if you need one, but M1 is a great tool that can allow you to passively invest your money yourself. Minority Mindset is a paid partner with M1, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and create a free account with M1, I got the link to how you can do that down in the description below, or you can go to theminoritymindset.com/M1. That's theminoritymindset.com/M and the number 1. And with that, let's go back to the show.
The second thing that I want to go over is the why. Why are we seeing this disproportional divide between the investor class and the worker class? And this is where a lot of people have opinions about political agendas and whatnot, but I don't want to get into all of that. I want to talk about the financial side of things because that's what I understand most. What you want to understand here is the backstory, which is this divide between the working class and the investor class is not new. It didn't start in 2020 or 2019. This started many decades ago, and it really accelerated after 1971 when the United States dollar was taken off of the gold standard. And what that meant is that now the United States government had the ability, through the help of the Federal Reserve Bank, to spend an unlimited amount of money. Because before 1971, when the dollar was backed by physical gold, the United States government couldn't just spend an unlimited amount of money because it needed more gold. They needed more wealth in order to spend more money. And if they wanted to spend money they didn't have, then it was much more difficult because their currency was backed by a physical metal, the physical gold. Well, after 1971, the dollar was no longer backed by physical gold. The dollar essentially just became pieces of paper. And now the United States government had the ability to kind of spend whatever amount of money they want. And it also gave the Federal Reserve Bank the ability to print an unlimited amount of money because now it doesn't need more physical gold to support the money printing. So when now you have this unlimited money printing with no constraints on how much you can print, that devalues the currency. So now when you are a worker and all you're doing is you're exchanging your time for dollars, you're working to exchange your time for a currency which is also being reduced in value partially due to government spending. Because when the government spends money they don't have by printing money, that dilutes the value of each individual dollar. So now for the average worker, you're going to work every single day to get paid. Great. Now that same paycheck that you're working to earn and that you're working to save is being diluted through the government spending and the Federal Reserve Bank printing. Well, that has been happening for the last number of decades. That's why even if you look at pre-pandemic numbers from 1970 to 2019, the value of the dollar dropped significantly. I mean, you could buy a median home back in 1970 for $20,000. Back in 2019, you needed almost a couple $100,000 to buy the median-sized home in America. Why? Because, well, in addition to the normal government spending, which was creating the normal amount of inflation that we've been seeing for the last number of decades, we also saw the pandemic spending. And the United States government spent $5 trillion just on pandemic stimulus to stimulate the economy, to stimulate the American consumer, to stimulate the businesses in America. Now you got to understand, well, what is the cost of that and how much is this $5 trillion really? To put this in perspective, $5 trillion created between 2020 and 2021 is more than how much the United States government generated in taxes in 2019. In 2019, the United States government generated around $3.6 trillion in taxes. Now remember, the United States government only has one source of income: tax dollars through taxpayers. So in 2019, you would think that the government only had $3.6 trillion to spend, which it did, but then it spent more than that through their money printing. But in 2020 and 2021, the United States government essentially created an additional $5 trillion to go out and spend, which may make you wonder, why are we paying taxes in the first place when the government can create this money and spend this money essentially out of thin air? In fact, not just the amount of money that we generated, more than the amount of money that we are paying in taxes. The government can print this money out of thin air, yet every single person is working so hard to pay the government taxes. And to also put it in perspective, back in 2019, the entire size of the United States economy was right around $21 trillion. That means the United States government stimulated our economy by creating essentially 25% of our entire wealth out of thin air. Because this $21 trillion of GDP, $21 trillion of economy, that's how much money our United States economy generates after an entire year of working. The entire country, every single company from the east to the west to the north to the south, working for an entire year, has to go to work every single day to produce $21 trillion worth of wealth. The United States government created and spent $5 trillion in the blink of an eye. So now when you have this level of money printing, what does that do? Well, that creates inflation. And inflation, like I've been saying, disproportionately benefits the financially educated and disproportionately hurts the financially uneducated. Why? Because what does inflation do? Inflation, well, that essentially means your consumption is more expensive. It means that when you go to the grocery store and you have to buy things, you have to pay more money. When you have to go out and buy a home, you have to pay more money. When you want to buy a car, you have to pay more money. So inflation hurts consumers. And who is a consumer? Everybody. Rich people are consumers, middle class people are consumers, poor people are consumers. Everybody needs to eat and everybody needs a shirt on their back. So inflation hurts everybody on the consumption level. But at the same time, inflation also benefits some people. Because now when people have to go out and spend more money at Walmart, when people have to spend more money at Target, when people have to spend more money at BMW, that also benefits some people. Because that means more dollars are now going to these businesses. Who does that benefit? Well, it benefits the owners in these businesses. Now, who are those people? Well, anybody can be an owner in that business. And the people that are owners in the companies in America, the people that are the owners of the assets are, of course, the financially educated. It's not just the rich people, it's the financially educated, because the financially educated are taking their income from their job and they want to buy assets. Whether it's stocks, whether it's startups, whether it's real estate, they're buying these assets, which then are generating more dollars through the inflation. And so then what happens? Well, as you see more inflation, more dollars are going to these businesses start to increase in value, and who does that increase in value benefit? It doesn't benefit the workers in these companies. Like if you're working at Walmart, if Walmart becomes a more valuable company, that doesn't benefit you unless you own stock in the Walmart company, unless you're getting paid with any stock, but it does benefit you if you're an investor in the Walmart stock. Now, again, you don't need to be a millionaire to start investing in Walmart. I mean, anybody can start investing in a company with as little as $1 nowadays. But when you have inflation, it disproportionately benefits those people. Now you might be saying, oh, this is bad and this is evil. Well, you got to understand, investing also comes with risk, because the investor that owns the Walmart stock also bears the risk when the Walmart stock goes down. Because remember, number one, there's risk with investing in assets, which is why you have to understand that there's risk with investing. But the benefit is when asset prices go up, when this inflation happens, it also benefits some people more than others, which is why you have to understand what is going on, because our system is designed to create inflation. And you might say, Jaspreet, how can you say that? Well, the Federal Reserve Bank makes it very clear. They say that they want a target of 2% inflation. They don't say that they want 0% inflation. They say that they want 2% inflation, which means that they still want inflation. Again, who does inflation benefit? Inflation benefits the financially educated. Inflation benefits the people that understand it. But inflation hurts the people that don't understand it. Inflation hurts the people that are just workers. Inflation hurts the people that are not investors. Inflation hurts the people that are just consumers, because inflation makes everything you buy more expensive. It means your paycheck can't stretch as far. It means you have to spend more money in order to afford life. But inflation benefits the people that understand how inflation works. And this brings us to point number 3, which is now the correction that a lot of people are worried about. Now, we've been covering everything going on in the economy with Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. If you have not joined Market Briefs yet, I promise that you're going to love it. And you're probably going to say, but Jaspreet, how can you promise that I'm going to love it? Well, if you don't love it, you can unsubscribe at any time because it's free. So if you haven't joined Market Briefs yet and you want to stay up to date on what's happening, well, I got the link to how you can join Market Briefs down in the description below, or you can go to briefs.co/market. That's briefs.co/market. And when it comes to the correction now, what I want you to understand here is we are now in a phase where the Federal Reserve Bank is trying to undo what they did here. When we saw this massive money printed, when we saw all these stimuluses happening, there was this big talk that all this money printing would not cause inflation, that all this spending wouldn't create any inflation issues. And then when we started to see inflation issues, it was that this inflation was transitory. Well, now we know that this inflation is not transitory and that this did cause inflation issues, which is why the Federal Reserve Bank has been working now to fight inflation. How are they working to fight inflation? Well, number one, they've raised interest rates significantly. I mean, if you want to go out and buy a home, you want to get a car, you want to go out and borrow money, you see how much more expensive interest rates are. And number two, the Federal Reserve Bank has been doing what's called quantitative tightening, which is a fancy way to say that they're trying to essentially get rid of some of the money out there. How are they doing that? By selling off some of their treasuries. I've explained what that means in previous videos. I'm not going to go into that in this video because that kind of gets us a little bit more off topic than I want to go. But just note that the Federal Reserve Bank is now trying to correct what they did between 2020 and 2021, primarily, even a little bit in 2022, with the money printing, with the stimulus, with the low interest rates, with all these impacts on inflation. And so now, to correct the inflation problem, that does not mean that the Federal Reserve Bank is going to work to cause the prices of things to come down. We are not going to see 2019 prices anytime soon unless something crazy were to happen. And that's not the Federal Reserve Bank's goals. That's not the government's goals either. The goal is to cool down inflation, meaning bring inflation down to the 2% target. That means they still want the prices of things to rise, just not as fast as they were before. And now you gotta remember, inflation benefits some while hurting others. This is where now you have to understand that if you want to become wealthy in a country like America, the way that you do that is not by earning a big salary. I don't care how much money you make. I don't care what you do. I don't care if you are making $50,000 a year. I don't care if you're a doctor making $500,000 a year. I don't care if you're an NBA player making $5 million a year or even $50 million a year. You're never gonna become truly wealthy until you start diversifying away from your own income that you have to work to earn, because there's a limit to how much income you can earn. The reason being, you might say that I can make a lot of money at my job, I can make a lot of money in my business, great, but eventually you might want to retire. Eventually you might want to stop working. And if you stop working and the income stops coming into you, well, now you no longer have money to keep living that same lifestyle. The only way you can keep living that lifestyle is if you own some real assets. Now, maybe you can turn your own business into an asset if you can continue to get paid without you working there. Again, another topic for a different video. But if you have to work to get paid, if you don't get paid unless you're working, you're never going to be able to retire wealthy. You're never going to be able to actually become wealthy because you're always going to be relying on your efforts, on your labor, on your work to get paid. Now, it's not a bad thing to work to get paid. It's not a bad thing that you are working. But it's bad if that's your only source of wealth. The way you become wealthy is to have wealth that's reliant not just on you doing something. You want to have wealth that's reliant based off of what you own. That's real wealth. So now we are in a system where the Federal Reserve Bank is working to increase interest rates. They're working to do this quantitative tightening to reduce the inflation that we have. There are going to be consequences of this. Now, a lot of people don't like to talk about that because they get scared, they get worried, they panic and whatnot. But what you got to understand is that it is a part of our economic system. We have seen booms and busts happen in our economic system. They've happened every decade for the last century. We've seen recessions happen. We've seen market crashes happen. Now, am I saying we're going to see a market crash tomorrow? No. What I'm saying is there are going to be consequences to the Federal Reserve Bank's efforts to reduce inflation. Now, what does that mean? Well, we've already seen one consequence, which is the higher interest rates. When you go to buy a home, you have to pay much higher mortgage rates today than you did a few years ago. But now the question is this going to trickle down into other parts of the economy? Are we going to see more job losses? Are we going to see more economic pain? And everybody has an opinion, but what you need to understand is not what somebody's opinion is, whether we're going to see a recession in the next 12 months or not, but rather, how can you benefit whether or not we see a recession? How can you benefit no matter what happens in the economy? That's what I want you to understand, because every single person in the world has an opinion. I can sit here and tell you my opinion, but it doesn't do you any good because it's just an opinion. What I want you to understand is how can you win in our economic system no matter what's happening? And the way you win is by understanding now, how do you win no matter what happens? And the way that you do that is, number one, you have a strategy to win when markets are going up, and number two, you have a strategy to win when markets go down. And let's start by talking about how to win when markets go down, because that's a little bit easier to understand. When asset prices fall, that creates a good opportunity for you to go out and buy more of those assets at a discounted price. But in order for you to do that, you have to have money. So, if you see the stock market crash, if you see real estate prices fall, that creates an opportunity for you to go out and buy these assets at a discounted price. But in order for you to do that, you need to have money. And you have to be financially educated to know what to invest. So the way you do that is by, number one, investing in your financial education today. Start learning about investing. Start learning how to use your money. Start learning about how to analyze investments. And number two, put money aside. Not just to protect you. You want to have money to protect you if things were to go wrong. You want to have somewhere between 3 to 12 months worth of savings cushion to protect you financially against something bad happening, against you losing your income. So you have that, but then you also have money to put aside to invest. in case something bad would happen. Put this money into a high interest savings account, and then if you see a good opportunity, a good investment opportunity, well, that's where this cash is ready. It's not your emergency cash to protect you. It's a separate cash account to use in case something were to go wrong. Now, what about the flip side? What about if markets continue to go up? How do you win then? Well, the way you do that is by also not waiting to invest just for a market crash. You want to be investing when markets are up and down. And that means now looking for the right investment strategy for you. And for the average person, for 98% of America, what that means now is you have a passive investing system where now every week, every 2 weeks, maybe every month, some money is going to automatically be invested. If you're investing in stocks, it's going to automatically be invested into your portfolio of index funds, into your portfolio of mutual funds, or into your portfolio of ETFs. So now, every time you get paid, some money is automatically going to go and be invested. And this happens whether the market is up or whether the market's down. This is going to always happen. This strategy is something you want to do not for 6 months, not even for 6 years. You want to do this strategy for decades. If you have that type of mindset with this passive investing strategy, you will win, especially if you're investing in strong funds, things that are giving exposure to the broader economy, things that are giving exposure to strong companies here in the United States, because the advantage of these funds is you're not investing in one company, because if you invested in Sears from 1980 to 2000, you might have felt great. But then, well, we all know Sears ended bankrupt, and if all of your life savings were in Sears, down went all of your life savings. So instead of investing all of your money into one company, which sure, you can do this, if you understand the risks and if you understand how to actually invest your money and analyze investments. Most people have no idea how to do this. But if you don't want to spend your time analyzing investments, if you don't want to spend your time researching investments, if you don't want to spend the time keeping up with their investments, just invest your money into funds. Pay a little fee, because every fund, whether it's an index fund, ETF, or mutual fund, is going to cost you a fee. Pay a little bit of a fee and just invest your money there. That we could invest it into a broad portfolio of stocks, whether it's dozens of stocks or hundreds of stocks, maybe even thousands of stocks. Now you're just getting exposure to the United States stock market. Now you keep investing. When the market's good, you keep investing. When the market's okay, you keep investing. When the market's bad, you keep investing. This way now, when the market is going up, you're winning because, well, you keep investing here and you're seeing your asset portfolio rise. When markets go down, you keep investing here into this fund, and then you take this other pile of cash that you had and now you start dumping this into the markets when the market's down. That way you can stack up and load up on your assets when they're cheap. And this is where now you got to understand we're going through a correction phase in our economy. And by correction, what I mean by that is the Federal Reserve Bank is trying to correct what they did back in 2020, 2021, and into 2022. Now, is there going to be economic pain from this? Again, everybody has an opinion. I believe that we are going to see some economic pain from this, but that's just my opinion, right? Everybody has an opinion, but this is where now, regardless of what your opinion is, regardless of what anybody's opinion is, you got to understand that our economy goes through recessions. That's a fact. And, well, you want to be able to win when markets are up and down, but understanding that now we're going through this phase where the Federal Reserve Bank is doing this correction. You understand why this is happening. You understand that inflation is going to continue to happen. It is a part of our economic system and it's going to continue to happen. And you got to understand that investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube, but understand that in this country, in the United States of America, the way you become wealthy is not just through your salary, it's through your assets. And we're seeing that more prevalent now than ever before because of what happened over the last 5 years. The asset owners are going to continue to win. You're going to see a bigger divide between the financially educated and those who are not. And I want you to be on the side of the people that are financially winning, because now when you financially win, you can take better care of yourself, you can take better care of your community, and you can take better care of your family. And it costs money to eat and it costs money to feed other people. And in order for you to do that, you have to know how you can win in this financial system. And of course, we'll be keeping you updated on market briefs, which is why if you haven't joined yet, I got the link for you down in the description. In mid-2023, the consensus was that we would see steep Federal Reserve Bank interest rate cuts coming in 2024 as inflation subsides. The reason why so many people were optimistic about so many interest rate cuts in 2024 was because the Federal Reserve Bank essentially said that the inflation fight was over. Well, turns out it's not. It wasn't until a couple of months ago